Welcome to our series on financial motivation. Before we begin, it is crucial to understand that the information provided in educational and informational purposes only. The content is not intended to be a substitute for professional financial, investment, legal, or tax advice. We are not financial advisors, and the information presented here is not tailored to your specific financial situation. All financial decisions you make should be done in consultation with a qualified professional who can assess your individual needs and circumstances. The financial landscape in the United States is governed by a complex set of laws and regulations. Any strategies or ideas discussed are meant to be general in nature and may not be suitable for everyone. Investing involves risk, and you should never invest more than you are willing to lose. Past performance is not indicative of future results. We do not endorse any specific financial products, services, or companies. By watching to this video, you agree that you are solely responsible for your own financial choices and outcomes. The creators of this content shall not be held liable for any direct or indirect losses or damages arising from the use of this information. We strongly encourage you to conduct your own research and seek personalized advice from a licensed professional before making any financial commitments. Your financial security is your responsibility. Hello, and welcome to the first step on your path to financial empowerment. Today we begin a journey, not just of numbers and spreadsheets, but of mindset and intention. The financial world can often feel overwhelming, a place of complex jargon and intimidating charts. But at its heart, building a strong financial future is about simple, consistent actions. It's about taking control, one decision at a time. To guide us on this journey, we'll be exploring timeless wisdom from some of the world's most successful individuals. These quotes will serve as our compass, helping us navigate the often turbulent waters of personal finance. Our first quote, the very cornerstone of what we'll be discussing, is this: "A budget is telling your money where to go instead of wondering where it went." Let that sink in for a moment. Telling your money where to go. There's a profound power in those words. It's a shift from a passive role to an active one. It's the difference between being a passenger in your own financial life and being the driver, with your hands firmly on the wheel. For many of us, the end of the month arrives with a familiar, sinking feeling. We look at our bank accounts and ask, where did it all go? We know we earned a certain amount, but the tangible evidence of that hard work seems to have vanished into thin air. This is the financial fog that so many Americans live in. It's a state of uncertainty, of being reactive rather than proactive. This is where the concept of a budget comes in, not as a restrictive cage, but as a tool of liberation. The word budget often has negative connotations. We think of deprivation, of cutting out all the things we enjoy, but that's a misunderstanding of its true purpose. A budget isn't about saying no to everything. It's about saying yes to the things that truly matter. Imagine you're building a house. You wouldn't just start throwing bricks and wood together randomly. You'd have a blueprint, a detailed plan that outlines where every wall, every window, and every door will go. This blueprint ensures that you end up with a strong, functional, and beautiful home. A budget is the blueprint for your financial life. It's a plan that you create, based on your income and your priorities. It's you deciding in advance how you want to allocate your resources. You are the architect of your financial future. So, how do we start telling our money where to go? The first step is to understand where it's currently going. This is the discovery phase, and it can be an eye-opening experience. For 1 week, track every single penny you spend. Don't judge, don't change your habits just yet. Simply observe and record. You can use a notebook, a spreadsheet, or one of the many free budgeting apps available. That morning coffee, the subscription you forgot you had, the impulse buy at the grocery store checkout. Write it all down. At the end of that week, you'll have a snapshot of your spending. For many, this is a moment of revelation. You might be surprised at how much those small, seemingly insignificant purchases add up. This isn't a reason for guilt, it's a reason for empowerment. You now have data. You have knowledge, and knowledge is power. With this knowledge, you can move to the next step, creating your blueprint. Start with your income. What is the total amount of money you have coming in each month after taxes? This is your starting point. Next, list your essential expenses, what are often called the four walls. These are the things you absolutely must pay to live: food, utilities, shelter, and transportation. Be realistic with these numbers. Look at your past bills and spending to get an accurate average. After your essential needs are covered, you can start allocating money to your other goals and wants. This is where your personal values come into play. What is most important to you? Is it becoming debt-free? Saving for a down payment on a house? Investing for your retirement? Traveling the world? This is the beauty of a budget. It's a personalized plan. Your friend's budget might have a large allocation for dining out, while yours might prioritize saving for a child's education. Neither is right or wrong. They are simply reflections of different priorities. One of the most effective budgeting methods is the zero-based budget. This doesn't mean you have zero money. It means that your income minus your expenses equals zero. Every single dollar has a job. You assign a purpose to every bit of your income until there's nothing left to assign. Some dollars will go to rent, others to groceries, some to savings, some to paying off debt, and yes, some to entertainment and fun. By giving every dollar a name, you eliminate the mystery of where your money goes. You are in complete control. Let's talk about the psychological shift that happens when you start budgeting. That feeling of financial anxiety, the one that keeps you up at night, begins to fade. It's replaced by a sense of calm and confidence. You're no longer afraid to look at your bank account, because you know what to expect. You've created a plan, and you're working that plan. A budget also forces you to have honest conversations, either with yourself or with your partner. It brings your financial goals from the realm of vague dreams into the world of concrete action. Saying, "I want to be wealthy someday" is a wish. Allocating a specific amount of money each month to your investment account is a plan. It's important to remember that a budget is a living document. It's not something you set once and forget about. Your income might change, your expenses might fluctuate, and your goals will certainly evolve. That's why it's essential to review your budget regularly, at least once a month. This allows you to make adjustments and ensure that your financial plan continues to align with your life. Think of it like navigating a ship. You have a destination in mind, and you've plotted your course. But along the way, you'll encounter changing winds and currents. A good captain doesn't abandon the voyage. They make small adjustments to the sails and the rudder to stay on course. Your monthly budget review is your opportunity to make those small, necessary adjustments. For those in the United States, a budget is also a powerful tool for navigating the unique aspects of the American financial system. It can help you plan for things like health insurance deductibles, property taxes, and contributions to your 401k or IRA. When these expenses are built into your monthly plan, they are no longer surprises that can derail your progress. Let's address a common hurdle: the feeling of being overwhelmed. If you're just starting out, the idea of creating a detailed budget might seem like a monumental task. The key is to start small. Don't try to create the perfect budget in one sitting. Your first budget will be a draft, and that's okay. The goal is progress, not perfection. Another challenge is staying consistent. The first month of budgeting might feel exciting and new, but by the third or fourth month, the novelty can wear off. This is where discipline and a clear why becomes so important. Why did you start this journey in the first place? What are the long-term goals you're working towards? Keep those goals at the forefront of your mind. Write them down and put them somewhere you'll see them every day. This will provide the motivation to stick with your plan, even when it's challenging. In the coming chapters, we will delve deeper into topics like saving, investing, and building wealth. But it's crucial to understand that none of those things can be truly effective without the foundation of a solid budget. A budget is the launchpad for your financial success. So, your task for this chapter is simple, yet transformative. Embrace the idea that you are the one in control. Take that first step of tracking your spending. Start drafting your first budget. Begin the process of telling your money where to go. You work hard for your money. It's time to make your money work hard for you. And that starts with a plan. It starts with a budget. Thank you for joining me today. I look forward to continuing this journey with you in our next chapter. Welcome back to our series on financial motivation. Before we continue, it is essential to restate that the information provided in this audio is for educational and informational purposes only. The content is not intended to be a substitute for professional financial, investment, legal, or tax advice. We are not financial advisors, and the information presented here is not tailored to your specific financial situation. All financial decisions you make should be done in consultation with a qualified professional who can assess your individual needs and circumstances. The financial landscape in the United States is governed by a complex set of laws and regulations. Any strategies or ideas discussed are meant to be general in nature and may not be suitable for everyone. Investing involves risk, and you should never invest more than you are willing to lose. Past performance is not indicative of future results. We do not endorse any specific financial products, services, or companies. By watching to this video, You agree that you are solely responsible for your own financial choices and outcomes. The creators of this content shall not be held liable for any direct or indirect losses or damages arising from the use of this information. We strongly encourage you to conduct your own research and seek personalized advice from a licensed professional before making any financial commitments. Your financial security is your responsibility. Hello and welcome back. In our last chapter, we laid the foundation. We talked about creating a blueprint for your money, a budget that transforms you from a passive observer into the active architect of your financial life. We learned that a budget isn't about restriction, it's about intention. It's about telling your money where to go. Today, we're going to build upon that foundation. Once you know where your money is going, the next crucial step is to direct a portion of it towards its most important destination, your future self. This leads us to our second guiding quote, a cornerstone principle of personal finance popularized for generations. Pay yourself first. It's a simple phrase, just 3 words, but it represents a profound and radical shift in how most people handle their money. Think about the typical flow of money for the average American. The paycheck comes in. What happens next? The rent or mortgage is paid. The car payment goes out. The utility bills, the phone bill, the internet bill, they all get paid. Then come the groceries, the gas for the car, maybe some clothes, a dinner out. We pay our landlords, we pay the bank, we pay the power company, we pay the grocery store. We pay everyone else. And what happens at the end of the month? We look at what's left over, if anything, and that's what we try to save. The pay yourself first principle completely flips this script. It demands that you change the sequence. Before you pay a single bill, before you buy your groceries, before you even think about discretionary spending, you take a portion of your income and you pay yourself. And by pay yourself, we mean you move that money into a savings or investment vehicle. You prioritize your own financial future above all other non-essential obligations. Your savings is not a leftover. It is the most important bill you have to pay each month. This is more than just a financial strategy. It's a statement of self-worth. It's you telling yourself that your future security, your future goals, and your future freedom are more important than the temporary satisfaction of immediate consumption. It's an act of delayed gratification, one of the most powerful habits you can cultivate for long-term success in any area of life, but especially in finance. So how does this work in practice? It starts with your budget, the blueprint we discussed in Chapter 1. Within that budget, your payment to yourself should be a non-negotiable line item, right at the top. You have to decide on a specific amount or a percentage of your income that you're going to set aside every single time you get paid. For many people, a great starting point is 10%. It's a significant enough amount to make a real difference over time, but often not so large that it feels impossible to manage. If 10% seems too daunting right now, don't be discouraged. Start with 5%. Start with 1%. Start with $20. The crucial part is not the amount. It is the unwavering habit of doing it consistently. You are building a muscle. You start with a light weight and gradually increase it as you get stronger. The real key to making paying yourself first work is automation. Human willpower is a finite resource. If you have to manually transfer money to your savings account every payday, life will inevitably get in the way. You'll forget, you'll feel tempted to spend it on something else, or you'll convince yourself that you'll do it later. Automation removes willpower from the equation. It makes your most important financial goal your default setting. You can set up an automatic transfer with your bank or credit union. Have a predetermined amount of money moved from your checking account to your savings account the day after your paycheck is deposited. That way, the money is gone before you even have a chance to miss it or spend it. You'll be surprised at how quickly you adjust to living on the remaining amount. This is the definition of paying yourself first. The transaction happens automatically, without any further action required from you. In the United States, we have a powerful tool for automating this principle directly from our paychecks. The employer-sponsored retirement plan, like a 401k or 403b. When you contribute to one of these plans, the money is taken out of your paycheck before you even see it. It's the ultimate pay-yourself-first machine. If your employer offers a matching contribution, this is one of the most significant opportunities you have. An employer match is essentially free money. Contributing enough to get the full match should be a top financial priority for anyone who has this benefit available to them. Not taking advantage of a company match is like turning down a raise. Now let's talk about where this money you're paying yourself should go. Initially, the primary goal for many is to build an emergency fund. This is a crucial buffer between you and the inevitable financial surprises that life throws your way. A car repair, an unexpected medical bill, or a sudden job loss can be financially devastating without a safety net. Your emergency fund is cash saved in a separate, easily accessible savings account, typically enough to cover 3 to 6 months of your essential living expenses. This isn't an investment, it's insurance. It provides peace of mind and prevents you from going into debt when emergencies strike. Paying yourself first is how you build this fund, dollar by dollar. Once you have a healthy emergency fund, you can start directing your pay-yourself-first money towards other long-term goals. This could be saving for a down payment on a home, a child's college education, or most commonly for retirement. This is where your money starts working for you through the power of compounding. The concept of compounding is simple, but its effects are astonishing. It's the process of your earnings generating their own earnings. When you save and invest, your money earns a return. The next year, you earn a return not just on your original money, but also on the return from the prior year. It creates a snowball effect that, over decades, can turn small, consistent contributions into substantial wealth. But here's the critical point. Compounding needs time to work its magic. A dollar saved in your 20s is infinitely more powerful than a dollar saved in your 50s. By paying yourself first, starting today, you are giving your money the one thing it needs most to grow: time. You are activating the power of compound growth as early as possible. This principle fundamentally changes your relationship with money. Money ceases to be just a tool for immediate spending. It becomes a resource for building a life of freedom and choice. Every dollar you pay yourself is a vote for your future. It's a brick in the foundation of the life you want to build. Think about the feeling of financial security. It isn't about having a flashy car or expensive clothes. It's about having options. It's the freedom to leave a job you don't love, the ability to handle a medical emergency without panic, the capacity to be generous to others, and the peace of mind that comes from knowing you are prepared for the future. Paying yourself first is the direct path to creating that security. So let's make this practical. Your challenge after this chapter is to take action. Open that separate savings account if you don't have one. Name it emergency fund or future freedom. Then, go into your bank's website or app and set up an automatic, recurring transfer from your checking account. Schedule it for the day after you get paid. Start with an amount that feels manageable, even if it's small. The act itself is what matters most right now. If you have a retirement plan at work and you're not contributing, go to your HR department or online portal and sign up. At the very least, contribute enough to get the full employer match. This single step can dramatically alter your financial trajectory over the long run. This isn't about deprivation. It's about allocation. It's about making a conscious choice to prioritize your future well-being. By paying yourself first, you ensure that no matter what happens during the rest of the month, you've already taken the most important step towards securing your financial future. You've honored the commitment you made to yourself. Thank you for joining me today as we took this vital second step on our financial journey. Welcome back to our series on financial motivation. Before we delve into today's topic, we must reiterate that the information provided in this audio is for educational and informational purposes only. The content is not intended to be a substitute for professional financial, investment, legal, or tax advice. We are not financial advisors, and the information presented here is not tailored to your specific financial situation. All financial decisions you make should be done in consultation with a qualified professional who can assess your individual needs and circumstances. The financial landscape in the United States is governed by a complex set of laws and regulations. Any strategies or ideas discussed are meant to be general in nature and may not be suitable for everyone. Investing involves risk, and you should never invest more than you are willing to lose. Past performance is not indicative of future results. We do not endorse any specific financial products, services, or companies. By listening to this audio, you agree that you are solely responsible for your own financial choices and outcomes. The creators of this content shall not be held liable for any direct or indirect losses or damages arising from the use of this information. We strongly encourage you to conduct your own research and seek personalized advice from a licensed professional before making any financial commitments. Your financial security is your responsibility. Hello, and welcome back to your journey toward financial empowerment. In our first chapter, we established the power of a budget, the blueprint for telling your money where to go. In the second, we embrace the transformative habit of paying yourself first, ensuring that your future goals are the top priority. But even with the best laid plans and the most consistent savings habits, there is a powerful force that can undermine all of your progress. It's a force that promises instant gratification, but often delivers long-term stress. It is the single biggest obstacle to building wealth for millions of Americans. That force is debt. This brings us to our third, and perhaps most cautionary, piece of wisdom, often attributed to the great American statesman and inventor, Benjamin Franklin. Rather go to bed supperless than rise in debt. This quote may sound extreme to our modern ears. In a society where credit is readily available and often encouraged, the idea of foregoing a meal to avoid borrowing seems archaic. But the underlying principle is more relevant today than ever before. Franklin is speaking about the true cost of debt, a cost that goes far beyond the interest rate on your statement. He's talking about the loss of freedom. When you are in debt, you are not truly free. A portion of your future labor, your future paychecks, is already promised to someone else. You wake up in the morning, go to work, and spend your valuable time and energy, only to see a chunk of your earnings sent off to pay for decisions you made in the past. Debt is like an anchor, weighing you down and preventing you from moving forward toward your goals. Let's be clear, in the modern American economy, not all debt is created equal. Financial educators often distinguish between good debt and bad debt. Good debt is typically defined as borrowing for something that can increase your net worth or has the potential to grow in value. This might include a mortgage on a home or a student loan for a degree that significantly increases your earning potential. These are often taken on with careful planning and at lower interest rates. But the kind of debt that silently sabotages financial futures is consumer debt. This is the high-interest debt from credit cards, personal loans, and financing for depreciating assets like new cars. This is the debt that Franklin was warning us about. It's borrowing to fund a lifestyle that our income doesn't yet support. Think about how this works. You use a credit card to buy a new television for $1,000. If you carry that balance, you're not just paying back the $1,000. You're also paying interest, often at rates of 20% or even higher. That $1,000 television could end up costing you $1,500 or more by the time you pay it off. You are essentially paying a premium for impatience. This is the direct opposite of the principle we discussed in our last chapter. When you pay yourself first and invest, your money starts working for you, generating more money through compounding. When you are in consumer debt, the dynamic is reversed. You are working for your money, and the compounding effect is working against you, making the hole you're in deeper each month. It's a financial treadmill where you have to run faster and faster just to stay in the same place. The psychological weight of this can be immense. Debt can be a source of constant low-grade stress that affects your health, your relationships, and your overall well-being. It limits your options. You might feel trapped in a job you dislike because you need the income to service your debt payments. You might have to say no to opportunities, like starting a business or taking a sabbatical, because your financial obligations are too great. You lose your agility, your ability to pivot and take calculated risks. This is the modern equivalent of what Franklin meant. Rising in debt means waking up each day with this weight on your shoulders, this constraint on your freedom. So, how do we apply this centuries-old wisdom to our 21st century lives? The first step is a mindset shift. We must begin to see debt for what it is. Not a tool for convenience, but a claim on our future. We must learn to prioritize long-term freedom over short-term wants. This starts with the budget we created in Chapter 1. Your budget is your best defense against accumulating new debt. By telling every dollar where to go, you can plan for large purchases instead of impulsively putting them on credit. If you want a new phone or a vacation, create a sinking fund within your budget. A sinking fund is simply a savings account for a specific goal. You contribute a set amount to it each month, and when you have enough money, you make the purchase in cash. This method has a profound psychological effect. It delays gratification, which builds discipline. And when you finally make the purchase, you feel a sense of pride and ownership, not a sense of dread about the bill that will follow. You can enjoy your purchase fully, without any lingering financial guilt. For those who already find themselves burdened by consumer debt, the feeling can be overwhelming, even hopeless. But the same principles that build wealth can be used to eliminate debt. The journey out of debt begins with the decision to stop digging the hole deeper. This means committing to not taking on any new consumer debt. Once that decision is made, you can use your budget to find extra money to apply towards your debt payments. This is where the intensity and focus come in. It might mean temporarily reducing spending in other areas, eating out less, canceling subscriptions, or finding ways to increase your income. The short-term sacrifice is an investment in your long-term freedom. The cultural pressure in the United States to keep up with the Joneses is immense. We are bombarded with advertising that tells us we need the latest car, the newest gadget, the most fashionable clothes. Social media often exacerbates this by presenting a curated version of everyone else's life, making us feel like we're falling behind. Resisting this pressure is a revolutionary act. It requires a strong sense of your own values and your own goals. It means choosing the quiet confidence of a growing net worth over the temporary validation of external appearances. Living a debt-free lifestyle, or at least being intentional and aggressive about eliminating consumer debt, is one of the most powerful moves you can make on your financial journey. So your challenge for this chapter is one of reflection and resolve. First, look at your own relationship with debt. Do you use it as a tool for convenience or as a crutch? Second, if you have consumer debt, reaffirm your commitment to your budget and the pay yourself first principle. Use these tools not just to save, but to strategically plan how you will address what you owe. And third, make a conscious pact with yourself to practice delayed gratification on one purchase this month. Instead of buying it on credit, create a plan to save for it. By embracing the wisdom in Franklin's words, you are choosing a different path. You are choosing to build your life on a solid foundation of your own earnings, not on the fragile ground of borrowed money. You are choosing to rise each day a little freer than the day before. Thank you for being here today. I'll see you in the next chapter as we continue to build on these foundational principles. Welcome back. As we proceed, we must once again state clearly that the information in this audio is provided for educational and informational purposes only and does not constitute financial, investment, legal, or tax advice. The content is general in nature and is not a substitute for consultation with a qualified professional who can analyze your individual financial situation. We are not licensed financial advisors. Any decisions you make based on this information are your sole responsibility. The financial markets in the United States are regulated, and all investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. This audio is not an endorsement or recommendation of any specific financial product or strategy. We strongly urge you to perform your own due diligence and seek guidance from a licensed professional before making any financial decisions. Your financial well-being is in your hands. Hello and welcome to the fourth chapter in our motivational journey. So far, we have laid a critical groundwork. We've learned to command our money with a budget, to prioritize our future by paying ourselves first, and to break the chains of consumer debt that hold so many back. These are acts of financial defense. They are about control, discipline, and building a solid foundation. Today we shift from defense to offense. We move from simply managing our money to actively making it grow. This is the step that truly unlocks the potential for long-term wealth and financial independence. It's the concept of investing. And to guide our thinking, we turn to a beautiful and insightful quote from one of the most successful investors in history, Warren Buffett. Someone's sitting in the shade today because someone planted a tree a long time ago. This simple sentence perfectly captures the essence of true investing. It's not about quick wins, chasing hot tips, or trying to time the market. It is the patient, deliberate act of putting something of value into the ground today, nurturing it, and having the foresight to know that its true benefit, its shade, will be realized in the distant future. The person planting the tree may not even be the one who enjoys its fullest shade. It might be their future self, their family, or even generations to come. Let's first distinguish between saving and investing, as they are often used interchangeably, but serve very different purposes. Saving, which we've discussed in the context of an emergency fund, is the process of putting money aside in a safe, easily accessible place. Its primary goal is preservation of capital. It's your financial safety net. Investing, on the other hand, is the act of deploying your money with the expectation of generating a return. The primary goal of investing is growth. You are putting your money to work, buying assets that have the potential to increase in value over time. Why is this transition from saving to investing so critical for your long-term financial journey in the United States? The answer can be summed up in one word: inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. The cash you stash under your mattress or in a low-interest savings account might be safe, but it's losing its buying power every single day. A dollar today will not buy as much 10, 20, or 30 years from now. Saving protects your dollars. Investing has the potential to help your dollars outgrow the corrosive effect of inflation. This is the fundamental reason why investing is the primary vehicle for building wealth for long-term goals like retirement. The image of planting a tree is a powerful metaphor for this process. When you first plant a sapling, it's small and fragile. For a long time, it doesn't seem like much is happening.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
It requires faith and patience. You can't tug on it every day to make it grow faster. In fact, doing so would only harm it. You simply have to trust the process, provide the right conditions, and let time do its work. This is precisely the mindset required for successful long-term investing. When you put your money into the market, you are buying a small piece of the vast American and global economy. There will be seasons of growth and seasons of storm. Some days the sun will shine, and other days the wind will blow fiercely. The market will go up, and it will go down. An impatient investor, or a speculator, will panic during the storms and uproot their tree, often selling at the worst possible time. A patient, long-term investor understands that these fluctuations are normal. They continue to nurture their investment, trusting that over the long arc of time, the economy, like a well-planted tree, is biased towards growth. This brings us to the concept of risk. All investing involves risk. There is no guarantee of returns. The value of your investments can and will fluctuate. This is a fundamental truth that must be understood and respected. However, risk is a complex idea. There's the risk of losing money in the short term, but there's also the risk of losing purchasing power in the long term by not investing at all. For someone with a long time horizon, decades until retirement, for example, the risk of inflation may be far greater than the risk of short-term market volatility. The key is to manage risk, not to avoid it entirely. One of the most foundational principles for managing investment risk is diversification. In simple terms, this means not putting all your eggs in one basket. Just as a farmer wouldn't plant only one type of crop, an investor doesn't put all their money into a single company or a single industry. By spreading your investments across many different areas, you reduce the impact that any single negative event can have on your overall portfolio. For many Americans, tools like 401(k)s and IRAs make this process accessible. These accounts often offer options like mutual funds or exchange-traded funds, ETFs, which are inherently diversified. When you buy into a broad market index fund, for instance, you are essentially buying a tiny slice of hundreds, or even thousands, of the largest companies in the country. You are harnessing the collective growth engine of the entire economy. You are planting not just one tree, but an entire forest. The most powerful force on your side in this endeavor is the one we've mentioned before: compound growth. It's the engine that turns a small sapling into a mighty, shade-giving oak. When your investments generate returns, those returns are reinvested, and then begin to generate returns of their own. It's a snowball effect. In the beginning, the growth is barely noticeable. But over 20, 30, or 40 years, the results can be truly staggering. This is why the most important factor in investing is not how much money you start with, or your ability to pick the perfect investment. It is time. The long time ago in Buffett's quote is the magic ingredient. Every day you wait to start is a day you rob your future self of the power of compounding. Your challenge for this chapter is one of education and intention. Your task is not to rush out and make an investment tomorrow. Your task is to start planting the seeds of knowledge. If you have a workplace retirement plan like a 401(k) and you're not yet participating, your goal is to learn about it. Understand the options. If you are contributing, take a look at how your money is allocated. Are you diversified? This is the moment to shift your mindset from that of just a consumer and a saver to that of an owner. When you invest, you are becoming a part owner in the businesses that drive our world forward. It is a profound shift in perspective. Remember the tree. The financial decisions you make today, the consistent contributions, the patient mindset, the commitment to your long-term plan, are the seeds you are planting. You are doing the work now so that your future self, the person you will be in 10, 20, or 50 years, can sit in the shade, secure and provided for, thanks to the foresight and discipline of the person you are today. Thank you for joining me. In our next chapter, we will explore the mindset and habits that protect and nurture these trees you've planted. Welcome back to our series. It is imperative that we begin by reinforcing a critical message. The content of this audio is for educational and informational purposes only. It is not, and should not be considered, financial, investment, legal, or tax advice. We are not licensed financial professionals, and the general information shared here is not personalized to your specific circumstances. The financial environment in the United States is complex and regulated. Any actions you take regarding your finances should be based on consultation with qualified, licensed professionals who can properly assess your individual needs. All investing carries risk, including the potential loss of your initial investment. Past performance is no guarantee of future results. By choosing to listen, you acknowledge that you are responsible for your own financial decisions. The creators of this content are not liable for any outcomes that may result from the use of this information. We encourage you to be diligent in your own research and to seek personalized professional advice. Hello and welcome back. In our journey so far, we have assembled the essential tools for building a strong financial house. We started with the blueprint of a budget, laid the foundation by paying ourselves first, cleared the ground by addressing the burden of debt, and began planting the trees of investment for our future. But having the best tools and materials is not enough. A builder must also know how to use them. They need knowledge, skill, and the wisdom to understand the structure they are creating. This brings us to a crucial, empowering element of your financial journey: your own financial literacy. The most powerful tool you will ever have is your mind. This idea is perfectly encapsulated in our fifth quote, another piece of timeless wisdom from the brilliant mind of Benjamin Franklin. An investment in knowledge pays the best interest. This is a profound statement. In a world chasing percentage points on investments, Franklin reminds us that the highest and most reliable return comes from investing in ourselves, in our own understanding. This form of interest, the interest paid by knowledge, compounds in a way that money alone cannot. It protects you from mistakes, opens up new opportunities, and builds a level of confidence that no financial product can ever provide. Your financial journey is exactly that, your journey. While you can and should seek guidance from qualified professionals, no one will ever care more about your money than you do. Therefore, taking an active role in your own financial education is not a recommendation. It is an absolute necessity. You are the CEO of your own financial life, and it is your duty to be an informed and engaged leader. What does it mean to invest in knowledge in the context of your U.S. financial journey? It doesn't mean you need to become a Wall Street expert or a certified public accountant. It means taking the time to understand the fundamental concepts that govern your money. It's about moving from a state of financial mystery to one of financial clarity. Let's start with understanding the language of money. Terms like assets, liabilities, net worth, inflation, and diversification, which we've touched on, should not be intimidating jargon. They are the vocabulary of your financial world. Investing a little time to learn what these words truly mean is the first step. Understanding the difference between a stock and a bond, or a Roth IRA and a traditional 401k, gives you the ability to have meaningful conversations and make informed, rather than blind, decisions. An investment in knowledge also means understanding your own behavior with money. The field of behavioral finance has shown us that human beings are not always rational creatures, especially when it comes to financial decisions. We are susceptible to emotional biases. Fear can cause us to sell our investments at the bottom of a market downturn. Greed can cause us to chase speculative fads with no solid foundation. The fear of missing out, often fueled by news headlines or social media, can lead to impulsive and regrettable choices. Investing in knowledge means learning about these biases. By understanding your own psychological triggers, you can build systems to protect yourself from your worst impulses. It's the knowledge that helps you stick to your long-term plan when your emotions are screaming at you to do the opposite. It is the self-awareness that allows you to be the calm, patient gardener of your financial trees, rather than a frantic gambler. Furthermore, in the United States, the financial landscape is constantly changing. Tax laws are updated, new financial products are introduced, and economic conditions shift. An investment in knowledge is not a one-time event. It is a lifelong commitment to learning. It's about staying curious. It's about reading articles from reputable sources, listening to educational podcasts, and never being afraid to ask, what does that mean? One of the most valuable returns you get from this investment is the ability to ask good questions. When you do meet with a financial professional, your knowledge allows you to move from being a passive recipient of advice to an active participant in the conversation. You can ask about fees, risk levels, and the reasoning behind certain recommendations. This ability to engage critically and confidently is invaluable. It ensures that the financial plan you build is truly aligned with your goals and your comfort level. Think of it this way. If you were hiring a contractor to build your dream home, you would want to understand the basics of construction. You'd want to be able to read the blueprint, understand the difference between materials, and recognize quality work. You wouldn't need to know how to pour the foundation yourself. but you would need enough knowledge to ensure the job was being done right. Your financial life deserves at least that same level of informed oversight. So, how do you start making this investment in your own knowledge? You've already begun by listening to this series. The next step is to embrace curiosity. When you come across a financial term you don't understand, don't just skip over it. Take 2 minutes to look it up. When you review your bank statement or a retirement account summary, don't just look at the final number. Look at the individual transactions and fees. Try to understand what they mean. This is your challenge for this chapter. Make a commitment to invest just 15 minutes a week in your financial education. That's it. Just 15 minutes. During that time, you could read a chapter of a well-regarded personal finance book, watch an educational video from a trusted source, or simply read through the FAQ on your 401k provider's website. The goal here is not to become an expert overnight. The goal is to build a habit of learning. Like paying yourself first, these small, consistent deposits of knowledge will compound over time, yielding incredible returns. The confidence you will gain, the mistakes you will avoid, and the opportunities you will recognize will far outweigh any financial return you could chase in the market. An investment in knowledge pays interest in the form of clarity, confidence, and control. It is the single best investment you will ever make, because it empowers you to make all your other investments better. It transforms you into the capable, confident CEO your financial life deserves. Thank you for investing your time with me today. I look forward to seeing you in our next chapter. Welcome to the next chapter of our motivational series. We must begin with our standing advisory. The information presented in this audio is strictly for educational and informational purposes. It is not intended to serve as personalized financial, investment, legal, or tax advice. We are not licensed financial professionals, and this content is general in nature. The financial landscape in the United States is governed by specific laws and regulations. All financial decisions, especially those involving investments, carry inherent risk, which includes the potential loss of the money you invest. Past results are not an indicator of future performance. For advice tailored to your unique situation, it is essential that you consult with a qualified, licensed professional. By continuing to listen, you acknowledge that you are fully responsible for your own financial decisions and outcomes. The creators of this audio will not be held liable for any gains or losses that may result from the use of this information. Your financial journey is your own. Please navigate it with diligence and professional guidance. Hello and welcome back. In our journey together, we have built a powerful defensive and foundational strategy for your financial life. We have learned to direct our money with a budget, to prioritize our future selves, to avoid the chains of debt, to plant the seeds of long-term investments, and to empower ourselves with knowledge. Today we are going to explore a significant shift in mindset. It's a change in perspective that separates those who simply manage their money from those who truly build wealth. It's about changing your fundamental relationship with work and income. This powerful idea is captured in our sixth quote, a concept famously articulated by author and entrepreneur Robert Kiyosaki. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. This quote contains several layers of wisdom, but we're going to focus on that pivotal phrase, how hard it works for you. This is the core of a revolutionary idea. For most people, the financial equation is simple. They trade their time for money. They work an hour, they get paid for an hour. To make more money, they must work more hours, get a promotion, or find a higher paying job. Their income is directly and inextricably tied to their own personal effort and the finite hours in a day. There is a ceiling on how much they can earn because there is a ceiling on how much time they have. Making your money work for you is about breaking through that ceiling. It's about creating a system where your money becomes your employee. An employee that works 24 hours a day, 7 days a week, never calls in sick, and never takes a vacation. It's about building an army of dollars that are out in the world, generating more dollars on your behalf. To understand this concept, we need to grasp a simple yet profound definition of two words: assets and liabilities. For our purposes, let's define them in terms of cash flow. An asset is something that puts money into your pocket. A liability is something that takes money out of your pocket. The typical path for many in the middle class is to spend their lives acquiring liabilities that they believe are assets. A fancy new car, for example, is often seen as a sign of success. But does it put money in your pocket? No. It takes money out every month in the form of a payment, insurance, fuel, and maintenance. From a cash flow perspective, it is a liability. The goal is not to have a life devoid of nice things, but to understand their true financial nature. The mindset shift is to begin focusing your energy, your excess capital from your budget, and your knowledge on acquiring true assets. So what is an asset in this context? It's the tree we talked about planting in a previous chapter. It is a business, a piece of real estate, or a portfolio of stocks and bonds that generates income. It is something you own that produces a stream of revenue independent of you trading your time. When you buy a share of a dividend-paying stock, you are buying a tiny piece of a company. When that company earns a profit and distributes a portion of it to its shareholders, that dividend payment is money being put into your pocket. Your money, invested in that company, is working for you. When you reinvest that dividend to buy more shares, you are hiring more dollar employees, which then work to earn you even more money. This is the engine of wealth. This is not a get-rich-quick scheme. It is the opposite. It is a slow, methodical, and deliberate process of building. It starts with the principles we've already established. You use your budget to create a surplus. You use the pay-yourself-first principle to allocate that surplus toward acquiring assets before you pay for discretionary wants. You use your knowledge to understand what you are acquiring. Think of it as building two pipelines. Your first pipeline is your active income from your job. This pipeline is essential. It provides the water or cash flow that you need to live and to build. For most of us, this is our primary and most important source of income for a long time. The goal, however, is to use some of the water from that first pipeline to build a second, separate pipeline. This second pipeline represents the income from your assets, your money working for you. At first, this second pipeline is just a trickle. It might be a few dollars a month in dividends or interest. It seems insignificant compared to the flow from your main job. But you continue to direct a portion of your active income to building that second pipeline, making it stronger and wider. Over time, through consistency and the power of compounding, that trickle can grow into a steady stream, and eventually, into a powerful river. The ultimate goal for many on the path to financial independence is for the flow from the second pipeline, your assets, to become large enough to cover all of your living expenses. At that point, you are no longer required to trade your time for money to survive. Work becomes a choice, not a necessity. This is the definition of true financial freedom. This mindset changes everything. You begin to see the world through a different lens. You evaluate purchases not just on their cost, but on their opportunity cost. You might ask yourself, if I spend this $1,000 on a new gadget, I am giving up the chance to buy $1,000 worth of assets that could work for me for the rest of my life. This doesn't mean you never buy the gadget. It means you make the decision consciously, understanding the trade-off. Your challenge for this chapter is a mental one. It's an exercise in perspective. I want you to take a piece of paper and draw two columns. Label one assets and the other liabilities. Now list the things in your life under the column that fits our cash flow definition. Does it put money in your pocket, or does it take money out? Be honest with yourself. This is not an accounting exercise for a bank. It is a clarity exercise for you. The second part of your challenge is to start dreaming and brainstorming. On a separate piece of paper, write down this question. What kind of assets could I begin to acquire over time? You are not taking action yet. You are simply expanding your mind to the possibilities. You are starting to think like an investor, a capital allocator. You are starting to think about building your second pipeline. Embracing this principle of making money work for you is the transition from playing financial defense to playing powerful financial offense. It's how you move from a life of financial dependency to one of financial strength, choice, and lasting freedom for yourself, and potentially for generations to come. Thank you for joining me on this step of the journey. I'll see you in the next chapter. Hello and welcome back. Before we proceed, we must reaffirm our core principle. This audio is created for educational and informational purposes only, and is not financial, investment, legal, or tax advice. We are not licensed financial professionals. The information shared is general and not tailored to your personal financial situation. The financial system in the United States is complex. Every investment decision carries risk, including the possibility of losing money. Past performance does not predict future results. To receive guidance appropriate for your individual circumstances, it is vital to consult with a qualified and licensed professional. By watching to this video, you agree that you are solely responsible for your own financial choices. The creators of this content shall not be held liable for any decisions you make. Please conduct your own thorough research and seek professional advice to navigate your financial path. Hello and welcome back to your financial journey. We have traveled far, building a strong foundation with budgeting, saving, and debt avoidance. We've planted the trees of long-term investing, invested in our own knowledge, and shifted our mindset to focus on making our money work for us. But planting a tree is only the beginning of the gardener's work. The garden will face storms, droughts, and seasons of uncertainty. A successful gardener needs more than just a plan. They need the right temperament. They need patience, discipline, and the emotional fortitude to not panic when the weather turns. This is the inner game of investing, and it is often the hardest part to master. This leads us to our seventh, and perhaps most famous investing quote, a legendary piece of advice from Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. This is one of the most cited phrases in the financial world, yet it is arguably the most difficult piece of advice for any human being to follow. It goes against every natural instinct we have. Humans are social creatures. We are wired to seek safety in the herd. When everyone around us is rushing excitedly in one direction, our instinct is to run with them. When the herd is stampeding away in a panic, our instinct is to flee as well. Buffett's advice is a call to break away from this herd mentality. It is a call for rational, independent thought in a world often driven by collective emotion. Let's break down what it means. First, be fearful when others are greedy. This speaks to times of market euphoria. These are periods when everything seems to be going up. Financial news headlines are glowing, stories of people getting rich quick are everywhere, and it feels like you can't possibly lose. This is the peak of optimism. The dominant emotion in the market is greed. There's a desperate fear of missing out, or FOMO, that pulls everyone in. During these times, Buffett advises us to be fearful. This doesn't mean to panic or sell everything. It means to be cautious, to be skeptical, to be disciplined. It is the time to remember that prices of assets can become disconnected from their underlying value. When the crowd is consumed with greed, they often forget to ask critical questions about what they are buying. This is the time to stick to your long-term plan, to avoid chasing hype, and to ensure you are not overextending yourself. It's the moment to be the sober driver at a wild party. It requires discipline and the strength to resist temptation. The second half of the quote is even more challenging. Be greedy when others are fearful. This refers to times of market downturns, corrections, or even crashes. These are periods when the news is relentlessly negative. The headlines are filled with doom and gloom. People are panicking, selling their investments, and convinced that the sky is falling. The dominant emotion is fear. It is in these moments of maximum pessimism that Buffett suggests we should be greedy. Again, this is not a call for reckless behavior. It is a call for courage and opportunity. It means that when the crowd is selling indiscriminately out of fear, valuable assets can often go on sale. It's the financial equivalent of your favorite store having a massive discount. For the long-term investor who has done their homework, who has a solid financial foundation, and who has cash available precisely for these moments, periods of fear can present the best opportunities to acquire quality assets at lower prices. This is when the gardener, who has patiently waited, can add new trees to their garden at a significant discount. But doing so is incredibly difficult. It requires you to act in direct opposition to the prevailing mood. It means buying when everyone else is selling. It means having confidence in your long-term vision when the short-term outlook seems terrifying. It requires immense emotional control. This principle reveals a fundamental truth about long-term investing. The real risk for many investors is not the market itself, but their own emotional reaction to the market. More money has been lost by investors reacting to downturns than in the downturns themselves. Making impulsive decisions based on fear is one of the most reliable ways to destroy long-term wealth. So how do you cultivate this contrarian mindset? It goes back to the principles we've already established. First, your investment in knowledge. The more you understand about the historical nature of market cycles, that periods of growth and decline are a normal, expected part of the process, the less likely you are to be shocked or panicked by them. History provides perspective. Second, your long-term plan. Your financial plan should be your anchor in a stormy sea. It is the rational document you created during a calm and logical state of mind. When emotions run high, you should cling to your plan, not to the headlines. A solid plan acts as a firewall between your emotions and your money. Third, automation. The habit of paying yourself first and automatically investing a set amount on a regular basis is incredibly powerful. This strategy, known as dollar cost averaging, naturally makes you act on Buffett's advice without even thinking about it. When prices are high, your fixed dollar amount buys fewer shares. When prices are low and fear is high, that same fixed dollar amount automatically buys more shares. You are systematically being greedy when others are fearful. Your challenge for this chapter is to conduct a personal emotional audit. Think back to the last time you saw a scary financial headline or heard people panicking about the economy. What was your gut reaction? Did you feel the urge to check your accounts? Did you feel a knot of fear in your stomach? Be honest with yourself. Understanding your own emotional triggers is the first step toward managing them. The second part of the challenge is to write down a simple statement of your long-term financial philosophy. It could be something like, I am a long-term investor, not a short-term speculator. I will stick to my plan and not let market noise dictate my decisions. Put this somewhere you can see it. It will be your reminder, your personal mantra, during times of emotional stress. Mastering your emotions is the final frontier of your financial journey. It is the skill that allows you to execute your well-laid plans and truly reap the rewards of your discipline over the long run. It is the courage to stand apart from the crowd, to be calm when others are frantic, and to see opportunity where others see only fear. Thank you for being here today. In our next chapter, we will discuss the ultimate purpose behind building this financial strength. Welcome. We are about to begin, but first, our necessary reminder. The content provided in this audio is for educational and informational purposes exclusively. It is not, under any circumstances, to be considered financial, investment, legal, or tax advice. We are not licensed financial advisors. This information is general and not personalized for your unique financial situation. The United States financial system is governed by a framework of complex laws. All investment activities involve risk, which includes the potential for loss. Past performance is not an indicator of future returns. For advice that is tailored to your life and goals, it is crucial that you consult with a qualified, licensed professional. By listening, you affirm that you are in charge of and responsible for your own financial decisions. The creators of this audio are not liable for the consequences of any actions you may take. We strongly encourage you to conduct your own research and seek professional counsel. Hello, and welcome back to our shared journey. We have spent the last 7 chapters building a robust framework for financial strength. We've learned the practical skills of budgeting and saving, the strategic mindsets of investing and wealth creation, and the emotional discipline required to navigate the inevitable ups and downs. We have been focused on the how of personal finance. Today, we are going to take a step back and ask the most important question of all. Why? Why are we doing this? What is the ultimate purpose of accumulating wealth? Answering this question is what transforms financial planning from a dry exercise in numbers into a deeply meaningful life pursuit. To guide this introspection, we will use a simple yet profound quote often attributed to the author and marketing consultant, Chris Brogan. The goal isn't more money. The goal is living life on your own terms. Let that idea settle in. Money, in and of itself, is just paper and digital numbers. It has no intrinsic value. Its only true value lies in what it can do. It is a tool. A hammer is a useless block of metal until you use it to build a house. In the same way, money is a useless resource until you use it to build a life. The ultimate goal is not to have the biggest pile of tools in the shed. It's to build the most beautiful, meaningful life you possibly can. Living life on your own terms will mean something different to everyone. This is the moment where personal finance becomes truly personal. For one person, it might mean the freedom to leave a corporate job and start a nonprofit organization. For another, it could be the ability to travel the world and experience different cultures. It could mean having the time and resources to be fully present for your children as they grow up. It might mean being able to provide the best possible care for an aging parent without financial strain. Or it could be the peace of mind that comes from knowing you can weather any storm and have the capacity to be generous to those in need. This is why defining your why is so critical. Your why is the fuel that will power you through the difficult parts of this journey. When you are tempted to bust your budget, it's your why that will give you the strength to stay disciplined. When the market is volatile and scary, it's your why that will give you the courage to stick to your long-term plan. When you have to make short-term sacrifices, it is the clear vision of the life you are building that will make those sacrifices feel meaningful, not like a punishment. Without a clear why, the pursuit of money can become a hollow and endless chase. It's a game where the goalposts are always moving. You reach one financial milestone, and you immediately feel the need to strive for the next, without ever stopping to enjoy the freedom you've already created. This is the more trap, and it can be just as much of a prison as debt.
Disclaimer. The information presented is for informational purposes only, and is not professional financial, investment, or tax advice. All investments involve risk, and may result in partial or total loss. You should always conduct your own research, and consult with a qualified financial professional before making any financial decisions. By viewing this video, You agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
So, how do you define your why? How do you figure out what living life on your own terms looks like for you? This requires some deep and honest self-reflection. It's an exercise that goes beyond spreadsheets and calculators. Your challenge for this chapter is to set aside 30 minutes of quiet, uninterrupted time. Find a comfortable spot, take out a pen and a piece of paper, and ask yourself a series of questions. Write down your answers without judgment or filtering. Start with this. Imagine you have achieved complete financial independence. You have more than enough money to cover all your needs and wants for the rest of your life. You never have to work for money again. Now, what does your ideal day look like? What time do you wake up? What do you do with your morning? Who do you spend your time with? What activities fill your afternoon? What problems are you passionate about solving? This exercise helps to strip away the financial constraints and reveal what you truly value. You might discover that your ideal life isn't about luxury yachts and mansions. It might be about having the time to read, to learn a musical instrument, to volunteer in your community, or to simply take a long walk in nature every day. The next question to ask is, what is your definition of success? Our society often presents a very narrow definition of success, usually tied to job titles, income levels, and material possessions. But you have the power to create your own definition. Is success having a close-knit family? Is it making a positive impact on the world? Is it a life filled with adventure and new experiences? Is it a sense of inner peace and contentment? When you align your financial goals with your personal definition of success, your financial plan becomes an expression of your deepest values. Every dollar you save and invest is a vote for the life you truly want to live. Finally, think about your legacy. The concept of legacy isn't just for the ultra-wealthy. Every single one of us will leave a legacy, a story that is told through the lives we've touched. What do you want your legacy to be? Do you want to be remembered for your kindness, your generosity, your creativity, or your commitment to a cause you believe in? Financial resources can be a powerful tool to shape that legacy, whether it's through charitable giving, creating opportunities for others, or simply providing a foundation of security for your family. Once you have clarity on your why, on your ideal life, your definition of success, and your desired legacy, you can begin to build your financial plan around it. Your goals are no longer abstract numbers, like save $1 million. They become tangible life experiences, like have the freedom to be there for my family, or fund the cause I care about. This changes everything. It gives purpose to your budget. It gives meaning to your investments. It transforms your financial journey from a chore into an exciting and empowering act of creation. You are no longer just managing money. You are architecting a life. So please take the time to do this exercise. The clarity you will gain is the most valuable asset you will ever own. It is the compass that will guide all of your financial decisions and ensure that you are not just building wealth, but building a life that is truly rich in every sense of the word. Thank you for joining me for this important chapter. I'll see you in the next one. Welcome back to our series. We must begin with our standard and crucial disclaimer. The content of this audio is provided for educational and informational purposes only. It does not constitute and should not be interpreted as financial, investment, legal, or tax advice. We are not licensed financial professionals, and the information presented is general in nature. The financial system in the United States is governed by a complex set of laws and regulations. All investing involves risk, which includes the potential loss of principal. Past performance does not guarantee future results. To get advice tailored to your personal situation, it is essential to consult with a qualified, licensed professional. By listening, you acknowledge that you are responsible for your own financial decisions and their outcomes. The creators of this audio are not liable for any actions you take based on this information. Please conduct your own due diligence and seek professional guidance for your financial journey. Hello, and welcome back. In our last chapter, we delved into the heart of our financial journey by asking the most important question: why? We explored how defining our purpose, living life on our own terms, is the ultimate goal, and money is simply the tool to help us get there. But having a powerful why and a brilliant plan is not enough. The greatest visions in the world are meaningless without execution. And in the world of personal finance, execution is not about grand, heroic one-time actions. It's about small, seemingly boring, and relentless repetition. It is the quiet power of habit. This brings us to our ninth guiding principle, a piece of ancient wisdom often attributed to the philosopher Aristotle, that is the bedrock of all long-term success. We are what we repeatedly do. Excellence, then, is not an act, but a habit. This is a profound truth that applies to every area of life, from health and relationships to your financial well-being. Financial excellence, achieving the freedom and living the life you defined in our last chapter, is not the result of a single brilliant investment, a lottery win, or a sudden windfall. It is the cumulative result of thousands of small, disciplined decisions made day after day, week after week, and year after year. Think about the Grand Canyon. That immense, breathtaking wonder was not carved by a single, cataclysmic event. It was carved by the gentle, persistent flow of a river, molecule by molecule, over millions of years. In the short term, the river's effect is invisible. On any given day, you cannot see the change. But over a vast expanse of time, that consistent action creates something monumental. Your financial journey is the same. The small, positive habits you build are the river. Your long-term financial goals are the canyon. Let's connect this to the practical steps we've already discussed. The habit of budgeting. This isn't something you do once. It's a habit you practice every month. The act of sitting down, reviewing your spending, and creating a plan for the next month is the repetition that keeps you in control. Each time you do it, you get a little better, a little more efficient. Excellence in money management is simply the habit of budgeting repeated. The habit of paying yourself first. This is perhaps the most powerful financial habit you can build. Setting up that automatic transfer to your savings or investment account is the act. The habit is letting it run, month after month, without fail. It's making that contribution on the days you feel rich, and on the days you feel broke. It's trusting the process even when the results aren't immediately apparent. Financial freedom is the habit of paying yourself first, repeated. The habit of investing in your knowledge. This isn't about cramming for a test. It's the habit of staying curious. It's reading one article a week, listening to one educational podcast on your commute, or taking 15 minutes to look up a term you don't understand. Over a decade, these small, consistent deposits of knowledge build a deep well of wisdom and confidence. Financial wisdom is the habit of learning, repeated. The modern world is obsessed with speed and novelty. We look for the hack, the secret, the shortcut to success. But in finance, this mindset is dangerous. It leads to chasing fads, taking unnecessary risks, and abandoning solid plans for the promise of quick riches. True, lasting wealth is almost always boring. It's built on the slow, steady, and unglamorous foundation of good habits. The beauty of this principle is that it makes success accessible to everyone. You don't have to be a genius. You don't have to have a massive income. You just have to be consistent. A person with a modest income who develops strong financial habits can easily outperform a high-income earner who is financially undisciplined. The river of consistency will always outperform the flood of sporadic effort. One of the greatest tools we have for building these habits is automation. We touched on this earlier, but it's worth emphasizing here. Automation is the key to putting your financial habits on autopilot. By automating your savings, your investments, and even your bill payments, you remove the two biggest obstacles to consistency: willpower and memory. You don't have to wake up every morning and decide to be disciplined. You've already made the decision once, and the system takes care of the rest. This frees up your mental energy to focus on bigger things like your career, your family, and the why that drives you. You are building a financial machine that works for you in the background, powered by the force of habit. Your challenge for this chapter is to conduct a habit audit, and then take one small step to strengthen your consistency. First, the audit. Look at the financial habits you currently have. Think about your monthly process with money. What are you doing consistently well? Maybe you never miss a credit card payment. Acknowledge that. That is a powerful positive habit. Where are the inconsistencies? Do you budget for 2 months and then fall off the wagon? Do you manually transfer money to savings, but only when you feel like it? Identify one area where your consistency could be improved. Second, the action. Based on your audit, choose one single, small action you can take to make that habit more consistent. If budgeting is the issue, don't promise to build the world's most perfect spreadsheet. Instead, just set a recurring 20-minute appointment in your calendar for the last Saturday of every month to review your finances. If saving is the issue, and you haven't automated it yet, make it your one goal this week to log into your bank account and set up that automatic transfer. The key is to make the action so small and so easy that you can't say no. Remember, the goal is not a dramatic overhaul overnight. The goal is to make a 1% improvement in your process. It is to make the river flow just a little more steadily. Over time, these tiny improvements in your habits will compound into massive results. You are the sum of your habits. The financial life you will have in 10 or 20 years will not be determined by the state of the economy or the whims of the market. It will be determined by the small, repeated actions you take, or fail to take, starting today. Choose to build the habits of excellence. Choose to be the river. Thank you for your commitment to this process. I will see you in our final chapter. Welcome to the final chapter of our series. We will begin one last time with the most important message. This audio is for educational and informational purposes only. It is not financial, investment, legal, or tax advice. We are not licensed financial professionals. The information shared is general in nature and has not been tailored to your specific personal circumstances. The financial system in the United States is complex and regulated. Every investment decision you make involves risk, including the potential for losing the money you invest. Past performance is never a guarantee of future results. For advice appropriate for your individual situation, it is imperative that you consult with a qualified, licensed professional. By watching to this video, you acknowledge that you are fully responsible for your own financial decisions and their consequences. The creators of this content are not liable for any outcomes resulting from the use of this information. Your financial future is your responsibility. Navigate it with diligence, curiosity, and professional guidance. Hello, and welcome back for our 10th and final chapter. We have traveled on a significant journey together. We started by learning to take control, to tell our money where to go with a budget. We built a foundation of prioritizing our future by paying ourselves first. We faced the challenge of debt, planted the seeds of long-term investment, and committed to the lifelong pursuit of knowledge. We shifted our mindset to make our money work for us, learned to master the emotions that can sabotage our plans, define the ultimate why that gives our journey meaning, and embrace the immense power of habit. Now, as we stand at the end of this series, you may be feeling a mix of emotions. You might be inspired and motivated, ready to take on the world. You might also feel a sense of regret, thinking, I wish I had known all this sooner. I wish I had started years ago. This feeling is normal. It's human. This brings us to our final quote, a timeless piece of wisdom that serves as the perfect call to action for every single person, no matter their age or financial situation. It's an old proverb that says, the best time to plant a tree was 20 years ago. The second best time is now. This quote is the ultimate answer to the paralysis of regret. Yes, it would have been wonderful if you had started saving and investing 2 decades ago. The power of compounding would have worked its magic in incredible ways. But you cannot change the past. The time that has passed is gone, and dwelling on it is a waste of your most valuable resource, the present. Regret is a thief. It robs you of the energy and focus you need to build a better future. The quote doesn't ask you to ignore the wisdom of the past, it acknowledges it. It validates that feeling of wishing you'd started sooner. But then, it immediately pivots you toward the only thing you can control. Your actions today. The second best time is now. These 5 words are a declaration of hope. They are a statement of empowerment. They tell you that your current circumstances, your past mistakes, and your age do not disqualify you from building a better financial life. The journey of 1,000 miles begins with a single step, and your journey toward financial well-being begins with the next right decision you make, right now. Let's tie this back to everything we've learned. Maybe you're in your 20s. You have the most powerful asset of all on your side, time. Every dollar you invest now is a mighty seed. Your task is to start planting, consistently and patiently. The trees you plant now will grow into a vast forest that will provide shade and security for the rest of your life. The best time was when you turned 18. The second best time is today. Maybe you're in your 30s or 40s. Perhaps you've spent the last decade building a career, starting a family, and accumulating some debt along the way. You might feel like you're behind. You are not. You have the benefit of a higher income and more life experience. Your task is to get intentional, to create that budget with precision, to automate your savings aggressively, and to start planting your trees with purpose. The best time was 20 years ago. The second best time is this very moment. Maybe you're in your 50s or beyond. You may look at the finish line of retirement and feel a sense of anxiety. Please do not despair. The power of focused, intense effort over the next decade can be astounding. This is not the time for regret. It is the time for action. Your wisdom and experience are your greatest assets. You understand the value of hard work and discipline. The best time was 20 years ago. The second best time is now, with the full force of your wisdom guiding you. This journey is not about comparing yourself to others. Your path is your own. The person you see on social media with a seemingly perfect financial life has their own struggles and their own story. Your only competition is the person you were yesterday. Your goal is to be a little bit wiser, a little more disciplined, and a little more intentional with your money today than you were before. This series was called 10 Finance Quotes to Motivate Your U.S. Financial Journey. Motivation is what gets you started. But as we learned in our chapter on consistency, it is habit that keeps you going. The initial spark of motivation you feel right now is wonderful. Your challenge is to capture that spark and turn it into the steady, enduring flame of habit. So what is your now? What is the first small step you can take today? Is your now finally downloading your bank statements and tracking your spending for 1 week? Is your now logging into your HR portal and increasing your 401k contribution by just 1%? Is your now setting up that automatic transfer to a savings account, even if it's just for $25? Is your now reserving a book on personal finance from your local library? Is your now having an honest conversation with your partner about your shared financial goals? Whatever it is, choose one thing. Make it small, make it achievable, and do it today. That single action is you planting a tree. It may look small and insignificant, but it is the start of a new season of growth. It is you choosing your future over your past. It is you choosing hope over regret. Your financial journey is a marathon, not a sprint. There will be challenging miles and moments of fatigue, but by building a foundation on the principles we've discussed, you will have the strength to endure. You will have the map, the tools, and the mindset to reach your destination. A life lived on your own terms. Thank you for investing your time and attention with me through these 10 chapters. The real journey, however, does not end here. It begins. It begins now. Welcome. Before we begin this chapter, we must state our essential disclaimer. The information provided in this audio is for educational and informational purposes only. It is not, and should not be construed as financial, investment, legal, or tax advice. We are not licensed financial professionals, and this content is general in nature, not tailored to your specific situation. The United States financial system is complex and regulated. All investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. For personalized advice that suits your individual needs and goals, it is crucial to consult with a qualified, licensed professional. By listening, you acknowledge that you are solely responsible for your own financial decisions and their consequences. The creators of this content are not liable for any actions you take based on this information. Please navigate your financial journey with diligence and professional guidance. Hello and welcome back. In our last chapter, we concluded with a powerful call to action. The best time to plant a tree was 20 years ago. The second best time is now. This was our final encouragement to move past regret and to begin right where we are. But taking action, especially in the world of finance, often brings us face to face with a powerful and paralyzing emotion: fear. The fear of making a mistake, the fear of losing money, the fear of the unknown. We become so afraid of making the wrong move that we choose to make no move at all. We stand on the sidelines, waiting for the perfect moment or the risk-free opportunity that will never come. This paralysis leads us to our 11th guiding principle, a quote from the legendary hockey player Wayne Gretzky, which applies to finance just as much as it does to sports. You miss 100% of the shots you don't take. This is a simple statement of profound truth. It reframes our entire understanding of risk. We tend to think of risk as the bad things that could happen if we take action. But Gretzky reminds us of the certainty of failure that comes from inaction. If you never shoot the puck, you will never score a goal. It's not a possibility, it's a guarantee. In your financial life, standing still is a shot you choose not to take. And in the modern economy, standing still is not a neutral act. It is an act of going backward. The force of inflation, which we've discussed, is constantly eroding the purchasing power of your money. The cash you keep safely in a low-interest account is like a block of ice on a warm day. It may look stable, but it is constantly, silently, and surely melting away. The risk of doing nothing is the guaranteed loss of your money's future value. Let's think about the shots on your financial journey. The shot of creating a budget. It can feel intimidating. You might be afraid of what you'll find, but by not taking that shot, you miss the opportunity to gain control and direct your money with purpose. You guarantee that you will continue to wonder where your money went. The shot of starting an investment plan, no matter how small. The fear here is obvious. What if the market goes down right after I invest? It might. That's a possibility. But by not taking the shot, You guarantee that you will miss out on the power of compound growth over the long term. You miss the single greatest wealth-building engine available. You are choosing the certainty of your money's value eroding by inflation over the possibility of long-term growth through market participation. The shot of investing in your knowledge. It takes time and effort. You might fear that it's too complicated to understand. But by not taking that shot, you miss the opportunity to become a confident and empowered steward of your own resources. You guarantee that you will remain dependent on the opinions of others, unable to critically assess the path you are on. The fear of failure is a powerful deterrent. No one wants to make a mistake. No one wants to lose money. But we must learn to distinguish between a mistake and a lesson. Not every shot in hockey goes into the net. Not every business decision leads to a profit. And not every investment will be perfectly timed. There will be times when you invest and the market drops. There will be decisions you make that, in hindsight, could have been better. This is not failure. This is feedback. This is the price of admission for being in the arena of wealth creation. The legendary baseball player Babe Ruth was known as the home run king, but he also held the record for strikeouts for nearly 30 years. He understood that to hit home runs, you have to be willing to swing the bat, and sometimes you will swing and miss. The only way to avoid striking out is to never step up to the plate. The key is not to take wild, reckless shots. It's not about gambling or chasing speculative tips. It's about taking calculated, educated shots based on the solid foundation you've built. Your budget, your emergency fund, your knowledge, and your long-term plan. It's about participating in a thoughtful and disciplined way. This brings us to a crucial redefinition of risk. The real risk is not participating in the economy's potential for growth. The real risk is being a spectator your entire life. Consider the risks of inaction. The risk that your savings won't keep pace with the rising costs of healthcare, housing, and education. The risk that you will be solely dependent on a single source of income from a job that could disappear at any time. The risk that you will reach retirement age and not have the resources to live with dignity and choice. These are not the dramatic, headline-grabbing risks of a market crash. They are the slow, silent, and far more certain risks of financial inertia. Your challenge for this chapter is to identify one shot you've been putting off due to fear. It doesn't have to be a big one. Maybe it's the shot of finally opening a high-yield savings account for your emergency fund because you're worried about the paperwork. Maybe it's the shot of logging into your company's 401k portal, which you've been avoiding because it seems confusing. Maybe it's the shot of having a transparent conversation about money with your spouse. Identify the shot. Acknowledge the fear you feel about it. And then take it anyway. Make one small move to get off the sidelines and into the game. The path to financial freedom is not paved with guarantees. It is a path of probabilities, discipline, and courage. It requires you to accept uncertainty and to act in spite of it. Every day you wait is a guaranteed miss. But every day you act, every small step you take, is a shot on goal. And you simply cannot score if you do not shoot. Thank you for joining me. I will see you in the next chapter. Welcome to the next stage of our journey. We must begin with our essential disclaimer. The content provided in this audio is for educational and informational purposes only. It is not financial, investment, legal, or tax advice. We are not licensed financial professionals, and the information presented is general and not personalized for your unique financial situation. The United States financial system is complex and regulated. All investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. To get advice tailored to your personal situation, it is crucial to consult with a qualified, licensed professional. By listening, you acknowledge that you are responsible for your own financial decisions and their outcomes. The creators of this audio are not liable for any actions you take based on this information. Please conduct your own due diligence and seek professional guidance for your financial journey. Hello and welcome back. In our last chapter, we confronted the fear of inaction, embracing the idea that you miss 100% of the shots you don't take. We established that in the game of finance, getting off the sidelines and participating thoughtfully is the only path to success. Today, we address one of the most common and dangerous myths in personal finance, a misunderstanding that keeps millions of hardworking Americans from ever building true wealth, no matter how much money they earn. It's the belief that a high income automatically translates to financial success. This leads us to our 12th guiding principle, a simple but powerful quote from financial journalist Charles A. Jaffe. It's not your salary that makes you rich, it's your spending habits. This quote cuts directly to the heart of what it means to be wealthy. In our culture, we often confuse being rich with being wealthy. We see someone with a high-paying job, a fancy car, and a big house, and we assume they are financially secure. But being rich is often just a measure of your income, your offense. Being wealthy is a measure of your net worth, of what you keep and grow, your defense. And in the long run, defense is what wins the championship. Imagine your finances as a bucket. Your salary is the water flowing into the bucket from a faucet. A high salary means you have a powerful, high-pressure faucet. But what truly determines if the bucket ever fills up? The number and size of the holes in the bottom. Your spending habits are the holes. You can have a massive faucet pouring water in, but if your bucket is riddled with leaks, it will never get full. Meanwhile, a person with a much smaller faucet, a more modest income, who has a sealed, solid bucket can easily fill it to the brim over time. This is what we see all around us in the United States. There are stories of doctors, lawyers, and executives with six-figure incomes who live paycheck to paycheck, drowning in debt. And there are stories of teachers, plumbers, and administrative assistants who, through disciplined habits, retire as millionaires. The difference was not their salary, it was their spending habits. This brings us to a concept known as lifestyle inflation, or lifestyle creep. It's the natural human tendency to increase our spending as our income increases. You get a raise, so you get a more expensive apartment. You get a bonus, so you buy a more luxurious car. You get a promotion, so you start dining at fancier restaurants. There is nothing inherently wrong with enjoying the fruits of your labor. The danger is when your lifestyle inflates at the exact same rate, or faster, than your income. When this happens, you create no new margin. You build no surplus. You are simply running faster on the same financial treadmill. You have a bigger faucet, but you've also drilled bigger holes in your bucket, and you're left with the same result: an empty bucket at the end of the month. True wealth is built in the gap between what you earn and what you spend. The goal of a successful financial life is to consciously and deliberately widen that gap over time. As your income grows, you should strive to keep your lifestyle relatively stable, allowing the gap to expand. That growing gap is the surplus, the capital, that you can then use to pay yourself first, eliminate debt, and acquire assets that work for you. This principle is incredibly empowering because it puts the control firmly back in your hands. You may not control how big of a raise your company gives you this year. You may not control the broader economy, but you have absolute, 100% control over your spending habits. You control the bucket. This is where the habits we discussed earlier become your superstars. Your budget isn't just a tracking tool. It's the blueprint you use to plug the leaks. Paying yourself first isn't just a saving strategy. It's the act of sealing the bucket before you even turn the faucet on. Ensuring the most important part of your income never has a chance to leak out. Avoiding consumer debt is the commitment to not drill new holes in your bucket. Your challenge for this chapter is an exercise in mindfulness. I want you to identify one area of your spending that might be a result of lifestyle inflation. Think about how you spent your money 5 years ago compared to today. Is there a new recurring expense that has become normal simply because your income has grown? It could be the daily premium coffee, the multiple streaming subscriptions, or the habit of ordering food delivery more often. Your task is not to judge it or even to eliminate it. Your task is simply to notice it. Acknowledge it. Then ask yourself a powerful question. Is the value this habit brings to my life greater than the value that same money could bring if it were sealing my bucket and filling it for my future self? There is no right or wrong answer. The goal of this exercise is to move from unconscious spending to conscious, intentional spending. Your salary is a tool, but it is a finite one. Your habits are a skill, and that skill can last a lifetime and be passed down for generations. Focus on mastering your habits, not just chasing a higher income, because it is your discipline, your intentionality, and your spending habits that will ultimately determine if your bucket fills up, securing a future of freedom and choice. Thank you for joining me. I will see you in the next chapter. Welcome. Before we dive into today's chapter, we must begin with our essential disclaimer. The content provided in this audio is for educational and informational purposes only. It is not and should not be interpreted as financial, investment, legal, or tax advice. We are not licensed financial professionals, and the information presented is general in nature. The United States financial system is complex and regulated. All investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. To get advice tailored to your personal situation, it is crucial to consult with a qualified, licensed professional. By listening, you acknowledge that you are responsible for your own financial decisions and their outcomes. The creators of this audio are not liable for any actions you take based on this information. Please conduct your own due diligence and seek professional guidance for your financial journey. Hello and welcome back. In our last chapter, we dismantled the myth that a high salary is the key to riches.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Landing on the truth that it's our spending habits that truly build wealth. We talked about the leaky bucket syndrome and the importance of sealing the leaks to allow our wealth to accumulate. This naturally leads to a critical question. What shapes our spending habits? Why do we make the financial choices we do? While our personal values play a huge role, one of the most powerful and often invisible forces at play is our environment. Specifically, the people we surround ourselves with. This brings us to our 13th guiding principle, a famous and transformative piece of wisdom from the late motivational speaker and author, Jim Rohn. You are the average of the 5 people you spend the most time with. This is one of the most profound truths of personal development, and it applies to your financial life with incredible accuracy. We are social creatures, wired to conform to the norms of our tribe. The attitudes, beliefs, and behaviors of the people in our inner circle become our unconscious baseline for what is normal. Think about your finances in this context. If the 5 people you interact with most are constantly talking about their latest purchases, financing new cars, and taking lavish vacations on credit, what does that normalize? It normalizes a lifestyle of high consumption and immediate gratification. It makes a budget seem restrictive, saving seem strange, and living below your means seem like a sacrifice. In that environment, every decision to save or invest requires an immense amount of willpower, because you are swimming against the current of your social circle. Now imagine the opposite. What if your 5 closest associates are people who discuss business ideas, share articles about investing, celebrate paying off their mortgage, and get excited about their savings rate? In that environment, good financial habits are the norm. Discussing money isn't taboo, it's a source of shared growth. In that circle, making disciplined financial choices requires less willpower because you are being carried by the current. This phenomenon is often called the keeping up with the Joneses effect, but it runs much deeper. It's not just about envy, it's about belonging. We adjust our behavior to fit in with our peers. This is why it is so crucial to be consciously aware of the financial culture of your inner circle. This effect is now amplified 1,000 times over by social media. Our 5 people are no longer just our friends and family. They include the hundreds of influencers and acquaintances we follow online. We are constantly exposed to a curated highlight reel of other people's spending, their vacations, their new homes, their designer clothes. This can warp our perception of normal, creating immense pressure to inflate our own lifestyles, often with money we don't have. It's like trying to keep up with 1,000 different sets of Joneses at once. So what is the solution? This is not about abandoning your friends or cutting off your family if they have poor financial habits. It is about consciously and intentionally curating your influences. It's about building an environment that makes your desired financial behaviors easier to achieve. First, you can actively seek out positive financial influences. This could be an accountability partner, a friend who is also on this journey with whom you can share your goals and celebrate your wins. It could mean joining an online community or a local club focused on personal finance or investing. The simple act of adding 1 or 2 people to your life who are on the same path can create a powerful counterbalance to negative influences. Second, you must curate your digital environment. Your social media feed is a powerful input into your brain. Take an audit of who you follow. If an account consistently makes you feel envious or triggers a desire to spend, consider muting or unfollowing it. It's not about judging them, it's about protecting your own mindset. Conversely, actively seek out and follow voices of financial wisdom and encouragement. Deliberately add positive inputs to your daily information diet. Third, and perhaps most importantly, you can strive to be the positive influence in your existing circle. You don't do this by lecturing or criticizing. You do it by quietly and consistently living out your principles. When your friends see you reaching your goals, feeling less stressed about money, and having more freedom, they will naturally become curious. Your example can become the positive influence that helps them start their own journey. You can be the change you want to see. Your challenge for this chapter is a 2-part influence audit. Part 1. Without any judgment, simply identify the 5 people or influences you spend the most time with. This can include online personalities, What is their general attitude towards money, spending, and saving? Just observe. This awareness is the first step. Part 2. Identify one positive financial influence you can consciously add to your life this week. It could be subscribing to an educational financial podcast. It could be joining a subreddit or Facebook group dedicated to financial independence. It could be buying a well-regarded book on personal finance. Take one small step to intentionally improve your environment. Your environment is like the soil in which you are planting your financial trees. You can have the best seeds in the world, but if they are planted in toxic soil, they will struggle to grow. By consciously curating your social circle and your daily influences, you are creating the rich, fertile soil that will make your financial growth not just possible, but inevitable. Thank you for joining me. I will see you in the next chapter. Welcome. Before we begin this chapter, we must state our essential disclaimer. The information provided in this audio is for educational and informational purposes only. It is not and should not be interpreted as financial, investment, legal, or tax advice. We are not licensed financial professionals, and the information presented is general in nature, not tailored to your specific situation. The United States financial system is complex and regulated. All investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. To get advice tailored to your personal situation, it is crucial to consult with a qualified, licensed professional. By listening, you acknowledge that you are responsible for your own financial decisions and their outcomes. The creators of this audio are not liable for any actions you take based on this information. Please conduct your own due diligence and seek professional guidance for your financial journey. Hello and welcome back. Over the course of our journey, we have focused intently on building. We've learned how to build a budget, build a savings habit, build an investment portfolio, and build a mindset of wealth. But as any skilled architect will tell you, building a magnificent structure is only part of the job. The other, equally critical part, is ensuring it can withstand the storms. As you begin to accumulate wealth, your financial life transitions from not just being about growth, but also about preservation. You have something of value to protect. This brings us to the critical concept of financial defense and risk management, perfectly summarized by our 14th quote, another piece of timeless wisdom from Benjamin Franklin. An ounce of prevention is worth a pound of cure. In life, and in finance, this is an undeniable truth. The cure is the frantic, expensive, and often debt-fueled scramble to fix a crisis after it has happened. It's the thousands of dollars charged to a credit card for an emergency room visit. It's the high-interest loan you have to take out when your car's engine fails. It's the devastating financial fallout from an unexpected life event. The prevention is the small, thoughtful, and proactive steps you take today to mitigate the impact of those future crises. An ounce of prevention isn't an expense. It's a strategic investment in your own peace of mind and financial stability. It is the moat you build around your financial castle. Let's talk about what these ounces of prevention look like in your financial life. The first and most important is one we've touched on before, but it deserves to be seen through this new lens. Your emergency fund. This is the absolute cornerstone of your financial defense. Having 3 to 6 months of essential living expenses saved in a liquid, accessible account is the ultimate ounce of prevention. It turns a potential catastrophe into a mere inconvenience. When the transmission on your car goes out, an emergency fund means you write a check. Without it, it means you take on new debt, adding another leak to your financial bucket and derailing your long-term goals. The small sacrifice of funding this account prevents the pound of cure, in the form of high-interest debt. Another powerful ounce of prevention is understanding the concept of insurance. In the United States, insurance is a fundamental tool for managing life's largest financial risks. The basic principle is simple. You transfer the risk of a catastrophic financial loss to a company in exchange for a regular, predictable payment, known as a premium. You pay a small, manageable amount to prevent a large, unmanageable one. Thinking about concepts like health, auto, and home insurance is not about expecting the worst. It's about having a logical plan in place so you can continue to hope for the best. Determining what coverage is appropriate for your specific situation is a complex decision, and one that should be made in consultation with a licensed insurance professional who can assess your personal needs. But the principle is a pure ounce of prevention. The principle also applies to the maintenance of your physical assets. Think about your car. Spending a small amount on regular oil changes and tire rotations is an ounce of prevention. It helps prevent the catastrophic, $1,000 engine or suspension failure down the road. The same applies to your home. Small repairs and regular maintenance prevent the pound of cure that comes with a major system failure. Being a good steward of what you already own is a fundamental part of protecting your wealth. We can even extend this principle to our own well-being. In a country with high healthcare costs, taking proactive steps for your health can be one of the most significant financial decisions you make. This isn't medical advice, but a simple financial observation. Preventative health checkups and a healthy lifestyle are an ounce of prevention that can potentially help you avoid a much more costly pound of cure in the future. Embracing this mindset requires a shift from being solely an investor or a saver to also being a protector. It's understanding that a strong defense is what allows your offense to keep scoring. When you know you have a safety net, you can invest with more confidence. When you know you are protected from life's major financial shocks, you can sleep better at night. This isn't about pessimism, it's about strategic foresight. Your challenge for this chapter is a preparedness audit. First, look at your primary ounce of prevention. Your emergency fund. Is it where it needs to be? If not, what is one small, concrete step you can take this week to get closer to your goal? Can you automate an extra $20 a week into that account? Second, think about one other area in your life where a small, preventative action could save you a major headache later. It could be financial, like creating a folder with all your important documents and passwords, and letting a trusted person know where it is. It could be practical, like finally scheduling that dental checkup or car maintenance you've been putting off. Choose 1 ounce of prevention, and take action on it this week. Building wealth is an exciting journey of growth and accumulation. But true, lasting financial security comes when you pair that growth with a robust plan to protect what you've built. An ounce of prevention is your investment in a future that is not only prosperous but also secure. Thank you for joining me. I will see you in our final chapter. Welcome to the final chapter of our series. We will conclude with our most important and consistent message. The information provided in this audio is for educational and informational purposes only. It is not, and should not be interpreted as financial, investment, legal, or tax advice. We are not licensed financial professionals, and the information presented is general in nature. The United States financial system is complex and regulated. All investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. To get advice tailored to your personal situation, it is crucial to consult with a qualified, licensed professional. By listening, you acknowledge that you are responsible for your own financial decisions and their outcomes. The creators of this audio are not liable for any actions you take based on this information. Please conduct your own due diligence and seek professional guidance for your financial journey. Hello, and welcome back for the final time. We have reached the end of a long and transformative journey together. We began with the simple, powerful act of giving our money a purpose with a budget. We built a foundation of discipline by paying ourselves first, breaking free from debt, and planting the trees of our future through patient investing. We committed to our own education, mastered our emotions, and curated an environment for success. We learned to protect what we've built. And most importantly, we defined our personal why. The reason we are on this path. We have spent our time together learning how to construct a strong and secure financial house. But a house, no matter how well built, is just a structure. What turns it into a home is the life that is lived within it. This brings us to our 15th and final piece of wisdom. A quote that elevates our entire journey from a financial exercise to a life philosophy. From the great statesman Winston Churchill, "We make a living by what we get. We make a life by what we give." This beautiful sentiment is the capstone of our entire discussion. What we get represents the entire process of earning, saving, and investing. It is the salary, the dividends, the growth of our net worth. It is necessary, it is important, and it has been the focus of our work together. Making a living provides for our needs and gives us the stability and resources to build from. But making a life is a higher calling. It is the ultimate purpose of building that financial strength. It is the shift from a mindset of accumulation to one of contribution. It is the answer to the question, what is all this for? The ultimate expression of financial freedom is the freedom to be generous. Generosity in this context is a rich and expansive concept. It is not limited to writing a large check to a charity, though it can certainly include that. Giving is a spirit, an attitude that can permeate every aspect of your life. You can give to your family. This is often the primary motivation for our financial journey. Giving your children a stable home, providing them with opportunities you never had, or having the resources to care for aging parents with dignity. and without stress is a profound act of generosity. You can give to your community. This can mean supporting local businesses, donating to the local food bank, or contributing to a community project. It can also mean giving your time. Financial security often buys back our time, allowing us to volunteer, to coach a kid's sports team, or to mentor someone starting their career. You can give to causes that matter to you. Whether it's protecting the environment, advancing medical research, or supporting the arts, your financial resources can become a tool to advance your deepest values in the world, creating an impact far beyond your own life. You can give to strangers. A generous tip for a server, buying a coffee for the person behind you in line, or helping someone who is facing a temporary hardship are all ways of making a life. These small acts create ripples of positivity in the world. This mindset shift from getting to giving is the final stage of financial maturity. It is the transition from a scarcity mindset to an abundance mindset. Scarcity fears there will never be enough and compulsively hoards resources. Abundance understands that the financial bucket can be filled to overflowing, and that sharing the overflow does not diminish you, but in fact, enriches your life in immeasurable ways. Generosity is the ultimate expression of confidence in your financial plan. It is the proof that you have moved beyond financial fear, and are now operating from a place of strength and security. As we conclude, think about your legacy. The financial assets you build will one day be passed on, but your true legacy will be the story that money tells. Will it be a story of a treasure locked away in a vault? Or will it be the story of lives touched, of opportunities created, and of values passed down through generations? You are writing that story with the financial decisions you make every single day. Our final challenge is not a task but a lifelong invitation. I invite you to create your own personal financial philosophy. Take all the lessons from our 15 chapters and distill them into a single sentence that will be your guiding star. Is it live intentionally, save diligently, and give generously? Is it build freedom for my family and make a positive impact? Whatever it is, make it your own. And then, put that philosophy into action in the smallest possible way. Find one opportunity this week to make a life by what you give. It does not have to be monetary. Give your full, undivided attention to a loved one. Give a heartfelt compliment. Give your time to a cause you believe in. Build the muscle of generosity. Our journey of 15 chapters ends here, but your real journey, the journey of using the tools you've gathered to build a meaningful, secure, and generous life, is just beginning. You have the knowledge. You have the principles. You are the architect of your future. Go forward and build a magnificent life. Thank you for sharing your time and attention with me. I wish you all the best on the wonderful path ahead.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.